Welcome to this video on building a shockproof portfolio. We'll explore how diversification, risk management, and protection can safeguard your investments. We can categorize risk into unsystematic and systematic types. Unsystematic risk is localized, like a broken pipe, and can be mitigated through diversification. Systematic risk, such as a hurricane, impacts the entire economy, but a well-built portfolio can better withstand it. A resilient portfolio has 6 dimensions or layers. True protection requires building through all 6 layers, not just focusing on the foundational asset classes. Studies suggest 25 to 30 stocks yield the most cost-effective risk reduction. Dimension 1 focuses on foundational materials or asset classes: stocks, bonds, real estate, commodities, and cash. These respond differently to market events, such as interest rate hikes. For instance, rising interest rates may weaken bonds, but strengthen real estate and commodities. Dimension 2 is the sector seesaw, emphasizing investment across unrelated industries. This isolates the damage from sector-specific crises. For example, a lockdown affecting airlines may elevate digital streaming, keeping the portfolio balanced. Dimension 3 is corporate anatomy, viewed as a 2x2 matrix of size and life cycle stage. A robust equity layer requires blocks in all 4 quadrants: small cap value, small cap growth, large cap value, and large cap growth. Dimension 4 involves stretching across space and time. Diversified geographically, domestic versus foreign markets, and by maturity lengths, short-term versus long-term investments. This provides cushions against localized economic forces and future rate changes. Dimensions 5 and 6 involve the invisible risks, tangibility, and platforms. The split deposit method, diversifying cash across multiple banks, mitigates platform risk. Holding physical gold bars alongside gold ETFs is an example of managing tangibility risk. The science of the build involves the correlation coefficient. Assets moving in opposite directions, a strong negative correlation, provide the best diversification. The goal is to buy assets with a correlation close to 0 or -1. Diversification is a trade-off that raises the floor and lowers the ceiling. While it protects against catastrophic loss and yields higher long-term baseline returns, it limits explosive short-term gains, which is why it's a good hedge. For beginners, prefabricated modules like ETFs and mutual funds offer a shortcut. These funds provide immediate access to automatically diversified baskets of assets, instantly upgrading your portfolio's shock resistance without building every block by hand.